Oil. The lifeblood of modern civilization, oil is indispensable. This single commodity fuels our cars, powers our industries, and underpins global trade. From the bustling factories of China to the quiet suburban streets of America, oil's influence is pervasive. Its price fluctuations impact everything from groceries to pensions. Despite the rise of renewables, oil remains critical. Its energy density and abundance ensure its continued dominance. For countries endowed with vast oil reserves, the economic benefits can be transformative. Oil exports generate substantial revenue streams, bolstering national budgets and driving economic growth. This influx of wealth often translates into higher living standards for citizens, with governments investing in infrastructure, healthcare, and education. Moreover, the oil and gas sector creates employment opportunities, both directly and indirectly. However, the blessings of oil wealth often come with a caveat. While oil can bring immense revenue and development opportunities, it also poses significant risks. Over-reliance on oil exports can lead to what economists call the resource curse. This term refers to the paradox where countries rich in natural resources like oil often struggle with economic instability. This phenomenon describes the paradoxical situation where countries with abundant natural resources often experience slower economic growth, higher inequality, and greater political instability than their resource-poor counterparts. Oil dependency can lead to a neglect of other economic sectors, hindering diversification and long-term economic resilience. Fluctuations in global oil prices can create significant volatility, making it challenging to plan and manage national budgets effectively. To illustrate the contrasting impacts of oil wealth, let's compare two oil-rich nations, Saudi Arabia and Norway. Both countries have vast oil reserves, but their economic strategies have led them down very different paths. Saudi Arabia, the world's largest oil exporter, has long relied on its vast reserves to fuel its economy. The kingdom's wealth is deeply tied to the oil industry. While this has brought significant wealth, it has also led to overdependence on oil, with the non-oil sector remaining underdeveloped. Norway, on the other hand, has adopted a different approach. The Scandinavian nation has taken steps to ensure long-term economic stability. Despite being a major oil producer, Norway has invested heavily in diversifying its economy, focusing on sectors like technology, manufacturing, and renewable energy, and establishing a sovereign wealth fund to manage its oil revenues for future generations. This fund is one of the largest in the world. This forward-thinking strategy has enabled Norway to mitigate the risks of oil dependency and achieve a high standard of living.